welcome to this live edition of Capital Ideas TV. I'm Mark Bunting, the publisher of Capital Ideas Media. Our guest today is Simon Hitzig. He's the CEO of Accord Financial. Now, Accord Financial is a 40-year-old commercial lender that has executed a successful transformation. We interviewed Simon's successor, Tom Henderson, about a year ago, a predecessor rather. Now, at that time, Accord was at the tail end of a 5-year growth plan. The process is largely complete and the results are impressive. The company's loan portfolio has nearly tripled and its business is more diversified than ever. Now, that's translated into some solid gains for shareholders. Accord Financial reported record results in the fourth quarter, just came out last week, and for the full year as well. Q4 revenue, for example, soared nearly 50% from a year earlier to an all-time high, while adjusted earnings followed with a 30% increase. 2018 earnings per share, again, for example, rose 72%. And that growth has not come at the expense of prudence either. The company's disciplined approach to lending has helped keep charge-offs down to just 0.3%. The end of Accord's 5-year plan signals the beginning of a new era for the company. Now, for more on that, we'll be joined in just moments by the President and CEO, Simon Hitzig. Let's have a look at his bio board. As mentioned, he is the CEO of Accord Financial. Prior to that, Senior VP of Corporate Development. Simon, in previous lives, has been a Board of Governors member at Goodman & Company, an Executive Vice President at Dynamic Funds. He actually started his working life at Dynamic Funds. He just told me off air a very interesting story, which we may get to. From an educational standpoint, Simon got his MBA from Georgetown University and BA in political science at York University, and he joins us now. Hi, Simon. How are you?
I'm very well. Thank you very much, and thank you for the intro. Fantastic.
Absolutely. Good. You enjoyed that? You liked a little, seeing your history there and summed up in 30 seconds?
Yeah. 53 years of my life in 30 seconds.
Yeah, there you go. Actually, why don't we start there? Because we were just talking off air about how you got the working bug, so to speak, as a young man working at Dynamic Funds at a very interesting time in the market's pre-'87 crash.
Yeah, I had been at university for a couple of years and hadn't enjoyed it. I was probably too young for university back in the day, and so I got a summer job at Dynamic Funds in 1987, and I loved it. I loved it. I loved the business. I loved the company, and so I stuck with it into the fall and through the crash of '87. And it was a difficult period, obviously, for the mutual fund business, but it allowed me to move up in the business very, very quickly. At the time, Dynamic was a no-load company, sold direct to the public, and during the week of the crash, every shareholder phoned us, and so that was trial by fire, but I had done the securities course and quickly became a service rep, dealing with investors on the phone. And I loved it. I loved the business and I loved working.
And probably an amazing learning experience for you as well. So let's fast forward, let's say 30 some odd years. Here you are, CEO of Accord Financial. You've been there about 8 years total. So for those who don't know, there are many who do know the company. For those who don't know, what exactly is Accord Financial? What does the company do?
Well, in a nutshell, we lend money to businesses. That's what we do. And you know, if you don't know, and many people don't know this, the banks in Canada and the U.S. Have left a gigantic chunk of the economy alone in terms of supporting with lending. And so we step in. We're a non-bank lender, and we lend money to companies that need financing. We do that in both countries, and we do it in a variety of formats, but in a nutshell, that's what we do.
I saw in your investor presentation that essentially business is split 50-50 between the U.S. And Canada. So taking that further, give us some real-world examples or a real-world example of an everyday financing. A small business comes to Accord, and what happens then?
Well, I'll take the example or an example of let's say equipment finance, which is one of the things we do. So I'll give you two examples at sort of either end of the extremes in terms of the types of businesses we lend to. So on the small end, we might finance a tow truck operator. The operator may have 5 or 6 tow trucks. He needs to buy a new tow truck. We'll finance that tow truck. Literally lend money so that he can buy the truck, and the truck is our collateral. So we'll do that. On the large end of town, and this is a real example from about 18 months ago, we financed a Quebec-based logistics company that needed to buy 65 trucks. And so we'll finance 65 trucks in the multi-millions of dollars. This is a large company with tens of millions of dollars of revenue, and they needed funding for a fleet, basically. So there's two examples.
So you lend as little as say $5,000 up to about $20 million. Is that right?
That's about right.
Yeah.
That's about right.
Interesting. Okay. So I mentioned this 5-year transformation off the top. So what was and what did Accord Financial look like 5 years ago? What do you look like now? Why were the changes made, and what changed in that time frame?
Well, that's the question. So let me just start by saying Accord has been in business 41 years. For nearly every one of those years, in fact 37 in a row, we've been profitable. So we've had a great business for decades, for 4 decades really. But for the first 35 of the 41 years, we focused on one product, and that product is lending against accounts receivable. So receivables finance, otherwise known as factoring. That was our product. It's a great product, and it served us well for 35 years and continues to be part of our business. 5 years ago, we decided to strengthen the business by expanding into adjacent areas of lending, and so that's the core of what the strategy was. And so what we did is we hired a handful of key executives. We developed a few really creative products in-house, and we acquired 3 companies. And in doing all of that work over the 5-year period, the company looks quite different today than it did 5 years ago. And the difference really, at its core, is the product range. So we can now provide solutions in multiple formats. We can lend on equipment, we can lend against inventory, we can lend against receivables, we can offer supply chain finance, we can offer small business term loans. And so our suite of products now has made us more valuable to our network of referral sources.
And do some of the companies that you deal with, A, are they often repeat customers, and B, do they sometimes utilize more than one of your products?
We do have that. Now that we have this suite of products, we have clients that are using multiple products for sure. But where it's made us more valuable is among our referral sources. So most of our business comes today from lawyers, accountants, finance professionals, commercial bankers who refer a client to us for financing. So in that network of hundreds and hundreds of referral sources, we are now more valuable. They don't need to guess whether the client can use factoring. They can just call us and say, do you have a solution? And now we typically do.
And because you've been around 41 years, as you say, do you find most of your business comes from that, or do you also have a sales force that is out there, boots on the ground, saying, hey, we're available here to finance you?
We do have a sales team, but the sales team is mostly focused on that referral network, on dealing with professionals. In the last 3, 4, 5 years, I would say we're starting to see more inbound business through social media and our website, basically.
So you talked about how you transformed the company along with your team. So how important was it to get into complementary businesses, but also to have the proper geographic footprint going into areas that maybe were underserved or where there's no overlap for you, that kind of thing?
Yeah, our business is still a people business, and so we almost never make a loan without meeting with management, meeting with the company, unless it's a tiny transaction, and so boots on the ground are important. So part of the transformation 5 years ago, we were in Toronto, Montreal, and South Carolina. That's where we ran our U.S. operation. We wanted to expand west, so we bought a company in Vancouver. We bought a company in Chicago, and we bought a company in Santa Monica. So we're now in 3 cities across the country in both countries, so 6 offices in total. And I think that's had an impact.
We are with Simon Hitzig. He's the CEO of Accord Financial, and we're finding out more about the company. So would you say that this was a gradual and incremental transformation for Accord over the course of 5 years, or was it fairly rapid?
No, I think it was we're a careful company. we have to be, the business we're in carries some risk generally, and so that's part of our culture, is to do things carefully. And our toe in the water really was a small acquisition we did 5 years ago. We bought an equipment finance company in Vancouver. And I think that really broke the seal for us.
Was that Clarion, am I right, or no?
Varian.
Varian, okay, Varian.
Yeah, Varian Capital in North Van, terrific company. And it went well. We bought the company. It was a $5 million portfolio at the time. It's now kind of in the mid-30s, around $35 million. But the fit was perfect. The cultural fit, the management team were fantastic. And I think that gave us confidence to do more acquisitions and to develop new products.
Right, and we'll talk more about the CapEx and bonded media, which is the Hollywood glamour one that I want to talk about later on in the show. So during this transformation, was there a moment where you and your team said, you know what, this is going really well, and it's really going to start to show in the numbers? Was there an inflection point?
Well, the growth started to show in the numbers really 8 quarters ago. So beginning early 2017, our portfolio started to grow and has now grown for 8 straight quarters. Earnings followed that, and you can see in the 2018 numbers, the earnings are catching up really in the numbers. So the growth started actually before our latest 2 acquisitions. Started beginning in 2017, but we did 2 deals in the second half of 2017 that are now showing up in the numbers in 18 and going forward.
I remember when we talked on the phone, you were quite excited about the numbers, the 2018 and Q4 numbers that came out last week, and rightfully so. So let's roll through some of the numbers. I mentioned them off the top of the show. You've got almost a smile on your face because it's obviously very gratifying. So Q4 revenue rose nearly 50% from last year. EBITDA up about 30%. Full year EPS, which really stands out for me in 2018, surging 72% compared to the previous year. And as you mentioned, a lot of it has to do with the acquisitions. But maybe give us some more flavor as far as how Accord is doing financially.
Well, this is as you're hinting at, it's a great time to tell the story because we do appear to have the wind at our backs and things are going well. I think if you dig in a little bit to the numbers, there are 2 things to think about. One is we're experiencing operating leverage, which is fancy phrase, but bottom line is we have a platform that we're now able to grow the top line, grow our portfolio, grow revenue at a substantial rate without the same rate of increase in our overhead. So, for example, just a quick example, 3-4 years ago we were running $100 million or $110 million of assets with 85 people. We're now running $340 million of assets with 100 people.
Really?
So, just about tripled the assets with only 15 new people. And that's the kind of thing that gets us excited because we can do more of that.
Tell us about the economy in the U.S. and in Canada. I talked to somebody from an alternative lender several months ago, and he said on the phone to me that the U.S. economy is on fire. He really emphasized those words. That was a few months ago. What's Accord seeing when you talk to your people, and what are you seeing in terms of U.S. economy, Canadian economy, and interest rates?
Well, so yeah, overall, with a few exceptions, you have to set aside the oil price collapse, which had a big impact in Western Canada. But if you set that aside, we've had a very long period of modest growth since the credit crisis, since coming out of the credit crisis. So we don't experience the economy on fire. That's not something we feel around our office. But it's been a long period of decent growth, and that overall is quite positive to our borrowers. And through that period, for most of it, we've seen interest rates come down, and that's also been generally positive for most of our borrowers. I think the other macro trend, which is not directly related to the economy, is the search for yield. And so big picture, now it's been at least 20 years that the investing community has been seeking out yield. Some of that money has found its way into our business. And so that's another sort of, macro trend, is that we see more and more competition over the last 10 years, often in the form of a private credit fund. And so we see new competitors that are structured that way. And that's been a challenge. It's also been fun. I mean, it keeps us on our game for sure.
I'm sure. Speaking of yield, we'll get to it later on in the show. Accord has paid a dividend for a long time, and you can talk about that. We're going to shift gears here, Simon, just briefly. Last week we had Paul Beatty on the show, the co-founder of BT Global Growth, and still in the financial space. One of the stocks he recommended was goeasy, the alternative lender. So let's have a listen and take a look at what Paul had to say.
They've actually met their numbers for 19 straight years. They've been public for 19 years. They always meet their guidance. I mean, it's a tremendous success story. We like it now. We've owned it for years, probably 10 years now plus. We actually like it more now than ever. So the stock, I'm not sure why. The stock got up to $50. It went up quickly, got up to $52. It came down last fall. I would argue that it should never have come down this much. By the way, they've done nothing but meet all their guidance. The numbers are very good. The stock got down to as low as 7 times earnings. I think even lower, maybe 6.5 times earnings. They pay a dividend, nice dividend. They have leverage. They're a finance company. They do have leverage, but they're less levered than the Royal Bank. I can tell you that. They also have a higher ROE than the Royal Bank. They basically take care of Canadians that want to borrow money, but that the banks don't touch, right? The banks don't lend money to their clients. So they charge higher rates, but they do a great job. They've been around for a long time. I think it's a growth company. The company grew 30+% last year. They've guided to higher 30% type growth this year. By the way, they give 3-year guidance. I mean, I think it's terrific. They map out what they're going to do for shareholders. If you believe their numbers, the stock is going higher. We think the stock should be way north of $50, where it was. We didn't sell a single share at $50. We're buyers here. What's not to like about the company? I think you're right. You quoted all these companies, the firms that are covering them. There aren't that many that are actually covering them. I think you quoted basically all of them. They all have targets significantly above where the stock is. The stock has had a nice little rally in the last few weeks, but my own personal target would be $80. Let's call it 2 years from now, 2.5, 3 years out. Given their guidance, the stock's going to be $80 and maybe higher.
That's Paul Beatty, a co-founder of BT Global Growth, last week talking about goeasy. We're back here with Simon Hitzig, the CEO of Accord Financial, who's been telling you about his company's 5-year transformation and how it has worked very nicely and is being borne out in the numbers. And speaking of numbers, let's talk about this lending portfolio that you have, $340 million roughly, which you've tripled over the past several years. And as you mentioned, the asset number has grown because of the acquisitions you've done. CapEx is one of them. Bonded Media is the company that I'd like to talk about because it's based in, I guess, Hollywood, right, essentially? Or
they're in Santa Monica.
Santa Monica,
sure.
okay, right. You've got an office there.
Yeah.
So your predecessor, Tom, talked about them. And at first blush, when you talk about a company that's financing film and TV ventures, one would think, well, that's kind of a lumpy business and you never know whether you're going to have a hit or not. But Tom seemed quite convinced that it was a very well-run business. You really like the management team, and it's a good fit for Accord. So what's your view of Bonded Media, and describe what they do exactly?
Well, Bonded Media Finance is a lender to film and TV productions, basically. So every film or TV production in Hollywood has multiple sources of financing. So Bonded will take a piece of a film. Bonded is never the only lender to a film. Typically, they're the last one in with the kind of the last piece of the puzzle and the first one out. So they're benefiting from a trend towards smaller productions. So more and more entertainment is delivered through Amazon and Netflix and so forth, and generally budgets in Hollywood have come down. So there are many films now under $10 million or even under $5 million budgets. The banks don't want to get involved in small deals, and so Bonded sees gigantic deal flow in that space. It's run by a terrific group of young guys there.
Right, and since you've taken it over, what have you seen in terms of the Netflix's influence and Amazon? You just mentioned them Because they've really shaken up the whole world, haven't they?
They, for sure. The old studio world is changing. The content now is going more through these channels. Oftentimes we can lend. Netflix, for example. This is one of the opportunities that we're seeing. If you deliver a film to Netflix, they will typically pay the producer over 24 or 36 months after delivery. That producer wants to get on and make the next film. So we can finance against those receivables, basically. And so the risk to us is Netflix strong enough to pay? For now, sure they are.
That's interesting, though. So the producer doesn't get paid for potentially a couple of years.
Exactly. And the producer always wants to move on.
Mm-hmm.
I mean, they can't wait. And so we have this opportunity to step in and take these small pieces of business at nice yield with limited risk.
Now, you've described Accord as a methodical, I'm sort of paraphrasing, but very deliberate in terms of acquisitions. So what does that pipeline look like right now? You don't do a lot of them, but when you do them, they seem to be quite meaningful for the company. So can you give us a hint at what sort of areas you're looking at?
Well, we're happy with what we have. And so we are always looking for acquisitions. The three that we've done in the last 5 years all shared something in common, which is there were founders that wanted to stay and build something great and felt that we could help. And so that was the formula for success. And so we would bring an environment that was conducive to growing a great business and capital. That's the other thing we can bring. Those are hard to find. We found 3 over 5 years. We looked at probably more than 50. And we continue to look. But for now, we're happy with the pieces of the puzzle we have in place.
And how many of those potential deals are coming to you with people knocking on your door, and how many are you doing the whole outbound thing, actually looking for them?
It's a mix. It's a mix. All the investment bankers in Canada and the U.S. know that we're in the market generally, and so we get inbound calls, but we're proactive as well.
Now let's get back to profitability with the company. So you've put up these BOFO numbers. How sustainable is that? Are you going to maybe it's going to still be strong, the growth, but maybe decelerate a little bit? Or what are you foreseeing?
That's a good question. Here are a few thoughts. I can't predict the future, but I'll give you a few thoughts. First is we didn't have all of the pieces of the puzzle in place until towards the end of 2017. So in October 2017, we closed our deal in Chicago, where we acquired CapEx Partners. And so we've had only 1 calendar year so far with all of these, with the 3 acquisitions and with the various products we developed, 1 calendar year. And the numbers are great, but it's just the beginning, in my opinion. That said, our portfolio has grown in the last 2 calendar years more than 50% in each year. I think that pace is not possible to keep up for a long period of time. So we're very confident we can continue to grow. Is it going to be 50% a year? That's a very tough one to a number to hit. But in addition to the growth from these pieces we put together, I mentioned earlier the operating leverage. We do think that the growth over the next couple of years will come with minimal extra spending on overhead.
How long for how many years, consecutive years, has Accord paid a dividend? The yield's about, 3% right now, roughly?
It's about 3.5%.
3.5%, okay.
And I believe it's been 32 years in a row.
Really?
Yeah.
And do you usually raise it pretty well every year?
The dividend payout has generally increased every year. I'm sure you'll see in the numbers that we've been on a bit of a pause for the last couple of years. So it's been 36 cents a year for the last 2 or 3 years as we've been growing. And that was deliberate. As the portfolio has grown, our need for capital has grown, and so we haven't hiked the dividend lately.
So we have investors watching right now. Let's bring it around to them. We're talking about this 41-year-old company that's completed this transformation. Things look good, the numbers are good, and yet it's also a company that Day Street doesn't pay much attention to. It's quite tightly held, I guess. There's not a big float. Mm-hmm. So what's the plan to get the retail investor and institutional investor more interested and more aware of what seems to be a good story?
Yeah, that's a challenge, and we would love the stock to trade more. And certainly, since we released our earnings a week ago, we've seen a little bit more action in the market. One of the things we are hopeful of is that in the fall, we raised $20 million through issuing convertible debentures, and so we now have $20 million worth of investment kind of out there in retail hands that can convert to stock at $13.50. So our goal is to hit that number. If we can get the stock up to $13.50, have those convert to stock, that should increase the liquidity, and that's step number one. Hopefully we can follow that up with more. But you're right. It's management owns a big chunk of stock, and management typically isn't selling.
But we've been looking at your 1 year, 3 year, 5 year, and 10-year charts, and certainly impressive over a 10-year basis. The 5 year, we saw the results of sort of the transformation with the company. But you can't argue with. We're just rolling through them now here. There's a 5 year, and we'll eventually see the 10-year. But you can't, from a long-term perspective, would you agree? You can't really argue with ultimately the growth.
Yeah, absolutely. Oh, there's the 10-year chart.
Yeah.
Yeah, it's good. We had that spike in 2015, but it's been pretty steady growth. And the one thing I would point out to all the analysts out there is the stock now is 8 times earnings, roughly 8 times earnings. For much of that period of growth from 2010, it was 10 times earnings. So we would like it to go back to that metric.
Mm-hmm. All right, this is where I'm going to lob it up to you. You can hit it out of the park. Is there anything we haven't covered? We're going to wrap it up here, but anything we haven't talked about? Anything you want to get across to people?
No, I think you set up this piece perfectly with a description of our transformation. The only thing I guess I could add to that is the key to success for 41 years is credit discipline, and that's a for most people that's not a very sexy thing to talk about, but that's really the key, is not to lose money by making bad loans, and I think that's the thing that we're most proud of is having been profitable now 37 years in a row, including multiple economic cycles, and we did that by prudent lending.
That's very impressive. Thanks for coming in, sir.
Thank you.
All right, we appreciate it. We enjoyed that. Simon Hitzig, the CEO of Accord Financial. We'll see him again, I'm sure, at some point. Thanks a lot for watching us. And now, if you're watching it, you're on our YouTube channel. So if you could share the video, that'd be great. To share it with your friends, leave a comment, and that'll get the word out that we're doing these live specials for investors, do-it-yourself investors, self-directed investors like yourself. Now, as we wrap things up, a reminder of a special offer from Capital Ideas. It's a 30-day trial. This gives you immediate access to our premium weekly digest. These are the research-based actionable investment ideas that are reserved for our paying subscribers. You'll get a sneak peek and access to 4 issues. You can find out what you're missing. Just go to capitalideasmedia.com/30-day trial/ we have a digest coming out today, Tuesday at 7 o'clock Eastern Time. That's the day we usually post it. Thanks for watching and taking part. Again, if you missed any part of the show, watch it on our website or on our Capital Ideas TV YouTube channel. It will sit there and live and breathe. So we will see you next time. Take care.